cessation of recently imposed trade restrictions would push growth higher and reduce inflation relative to the baseline. Similarly, a peaceful resolution of Russia's war of aggression against Ukraine or of the ongoing conflicts in the Middle East could improve consumer confidence and business investment. Looking ahead, the key policy priorities we see are as follows. First, monetary policy should remain prudent. Central banks will need to remain vigilant in view of heightened uncertainty and the potential for higher trade costs to push up wage and price pressures. Provided inflation expectations remain well anchored, policy rate reductions should continue in most economies, including the euro area, the United Kingdom and the United States. Second, fiscal discipline is key to reducing public debt ratios. Public debt across the OECD rose to 112% of GDP in 2023, up from 73% of GDP in 2007. Interest payments due on public debt account for a significant share of government expenditure, 1.5% in Japan, 2.1% in the euro area, and 4.9% in the United States. Debt burdens are significantly higher in many emerging market economies and low-income countries. So decisive fiscal action is needed to secure debt sustainability, retain the ability to react to future shocks, and address rising spending pressures, including from population aging, defence requirements, and climate change. We need to do more to better control growth in expenditures, improve spending efficiencies, reallocate spending to areas that better support opportunities and growth, and optimize tax revenues. Third, international coordination and multilateral dialogue are needed to ensure a rules-based trading system in good working order and to foster constructive solutions to trade tensions that avoid counterproductive trading barriers between countries. Import restrictive measures on goods are estimated to have affected just under 12% of world imports in 2024, which is up from 0.6% in 2009. Boosting economic resilience will require countries to pursue opportunities to lift these restrictions and new trading links and to diversify supply and customer bases. Fourth, countries should revive the pace of pro-competition reforms to reinvigorate productivity growth and boost living standards. We estimate that reducing regulations and entry barriers in services, energy, transport and e-communications sectors to the levels in the 5 top-performing OECD countries would increase GDP per capita by 0.8% over 5 years across the G20 advanced economies and by 1.8% across the G20 emerging market economies. Initiatives to reduce overly stringent regulations and cut red tape, such as in Greece over the past 5 years and recently in the United States, can enhance competition, innovation, and ultimately growth. Fifth, we need to adapt policies to accelerate the diffusion and adoption of AI. Our estimates indicate that successful adoption and diffusion of AI can increase labour productivity by between 0.4 and 0.9% per year over the next 10 years, rising to 1.5% if we optimise synergies between AI and robotics. Effective training programmes that promote AI-relevant skills, a robust digital infrastructure and energy supply, and clear regulations regarding data usage and safety will be important to maximise the productivity gains of AI. In closing, in a complex global environment, recent signals of economic weakening highlight the need for prudent monetary and fiscal policies, ambitious structural reforms, and multilateral cooperation. By taking these steps, governments around the world can lower risks and uncertainty, support economic resilience, and drive sustainable growth that improves incomes and living standards for their citizens. And with that, I pass the floor to our Chief Economist, Alvaro Pereira, to present the details of our updated economic outlook.
Thank you very much, Secretary General. I would also like to seize the opportunity to wish happy St. Patrick's Day to our Irish friends, and also to thank our teams from the Macroeconomic Policy Division, but also from across the Economics Department and the Trade Directorate that were deeply involved in our new forecast. So, as the Secretary General mentioned, we are steering through uncertainty, and in fact, as you can see in the first graph, economic policy uncertainty indicators and trade policy uncertainty indicators have increased quite significantly. As a consequence, we've seen that across several economies, we've seen activity indicators, the PMI indicators, have slowed down in economies such as Canada, the United States, but also in emerging markets like South Africa. In addition, we also had a decline in consumer confidence in many of these countries. In particular, for Canada, Mexico, the United States, and Brazil, there's been significant declines in consumer confidence. But in other parts of the world, this is also true. Another fact that I think is quite relevant and important to say is that in the past few months, we've seen a decline in inflation, in particular headline inflation. But now we had, in the last 3 months, in 60% of the countries that we follow, there's been not a dramatic, but some increase in headline inflation, as you can see in the left-hand side graph. And in particular, in some countries, headline inflation, countries like Brazil, the euro area, or the United States and Japan, but also the euro area, have had an increase in inflation. So additionally, inflationary pressures have increased, partly because, as you'll see a bit later, because of goods price inflation. And then I would like to take you to our new forecast. I would like to, first of all, before we talk about the new forecast, I would like to highlight what are the assumptions that we incorporated in this forecast. We assume that all the tariffs that have been implemented by the United States vis-à-vis other countries are in our baseline. So basically 20% tariff against China, 25% in terms of aluminum and steel tariffs, but also 25% in Mexico and Canada, and we assume retaliation. We also see, as we'll see in a second, we assume another scenario if not all these tariffs are introduced, the 25% against Canada and Mexico. What will be the impact? And you'll see the impact is quite significant as well. But let me walk you through very quickly about our projections. So first of all, as the Secretary General mentioned, we are going to have significant downgrades for virtually every single country of the G20. A downgrade to the global economy from 3.2% this year, or last year, to 3.1% this year and 3% next year. But also, in many countries, a significant downgrade. In the United States, for example, we are projecting growth of about 2.2% this year and 1.6% next year. In the euro area, growth will linger more or less around 1%, maybe a bit more next year, but not much more. In China, significant, also a downgrade, 4.8% this year and 4.4% next year. In Japan, 1.1% and this year and 0.2% next year. But, you know, the overall picture is one of generalized downgrades, partly because of trade uncertainty because of the economic policy uncertainty, but also the imposition of tariffs. Also important to say that we have some bright spots in the graph. First, Spain, there's been the latest data has been positive, and so the carryover impact leads to a more positive picture for Spain, but also tourism is doing fairly well there. Argentina doing a lot better than had been forecasted, and then partly because they are coming out of the adjustment program in a way that is the economy has been very strong, and we in the third quarter and the fourth quarter, and we expect this will continue. And also we upgraded Turkey, but almost everybody else we downgraded. In terms of inflation, this graph tells you inflation this year and next. As the Secretary General mentioned, what we expect is that inflation will come down, but the path towards coming down is higher. So that means that we expect a bit more inflation this year and the next. You know, it will take a bit longer to reach targets. And this obviously has an implication for monetary policy. I would like, before I move to risks, I would like to highlight the other scenario that I mentioned, in which if the tariffs, 25% against Canada and Mexico, don't go ahead, and only the tariffs that are already there, what will happen. And what you can see that there'll be additional growth in Mexico of about 1.3, 1.4% this year and the next. For Canada, an additional 0.6% this year and the next, and also for the United States, between 0.1 and 0.15. There'll be also reduced inflation. So if these tariffs don't go ahead, you can see that Mexico will have significant less inflation, about 0.7% this year and 0.3% next year. For Canada, the same thing, 0.5% this year and 0.5% next year. And for the United States, also a reduction in less pressures, in inflationary pressure, about 0.115 this year and 0.1 next year. So let me walk you through now the risks. Obviously, a big risk is that there will be further trade fragmentation. So in our scenarios, one thing that we said, we estimated together with our Metro model from the Trade Director and the Niger model from the Economics Department, what we estimated was 10% tariffs, that the United States imposes a 10% tariff against everybody else, and everybody else retaliates. And what's the impact? Well, the impact are here. In terms of, you can see that GDP levels are significantly affected. Mexico will have a decrease in GDP level after 3 years of about 1.3%. You can see in the United States about 0.7%, and Canada with a bit less, but a significant, high magnitude above 0.6%. And inflation, the three countries that will be most affected as well will be Canada, US, and Mexico, because they are so integrated. And so Canada, you'll see, have an additional inflation of about 0.9%. The United States about 0.7%, and Mexico more or less the same magnitude. But basically what we're saying, if there's further trade fragmentation, this will lead to a significant more inflationary pressures and lower economic performance, so less growth for most countries, but in particular to these three. Another risk that we think that is important to notice and to highlight is inflationary pressure. So what you can see in the shaded areas is inflation in the OECD countries. And you can see on the left-hand side goods price inflation, on the right-hand side service price inflation. As I've said several times, and we highlighted over the in the past few months, we've been concerned that service price inflation is fairly sticky and remains sticky. So it's not moving that much, about 3.6% right now for the OECD. Whereas the novelty, compared to the last outlook, is that goods price inflation has started to tick up. So there's an uptick of goods price inflation, partly because of food prices and other commodities as well. But you can see that now we have sticky price inflation, goods price inflation, even though it's just a small increase, at least, it's moving for the first time in a few months. So it's possible that inflationary pressures could resurge. And of course, with a more protectionist world, and the impact of tariffs that we just saw add pressures to inflation, likely this will happen. It adds to the pressure, adds to the inflationary pressure that we see in this graph. On the other hand, we've highlighted as well that public debt has increased quite substantially, not only in OECD countries, but for emerging market economies and for many low-income countries. For the G7, for the G20, what you can see here is that since the global financial crisis, there's been virtually in almost every country, with the exception of Turkey and Germany, a significant increase in debt to GDP ratio of about 30 percentage points. All across the OECD. So it's a very significant increase in that. So obviously, knowing that now we have additional pressures, not only we have very high debt levels, but also we have additional pressures on spending more for defense, spending more for the green transition, spending more also because of the aging costs. These very high debt levels pose a risk that obviously that something could happen. And so I'll come back to this in terms of policies. Finally, also, as was just highlighted as well, there's elevated equity valuations, which heighten the vulnerability to negative shocks. And so as a consequence, we think this, of course, if there's a negative shock, then stock markets might react. And so there is a risk of repricing if these negative shocks occur. So let me turn now to policies. What should governments do? First of all, knowing that there's additional inflationary pressures, but also we know that knowing that there's also a lot of uncertainty, what should the central bank do? We think that the most important thing for central banks is to remain vigilant and prudent. If many of these tariffs don't go ahead And if inflationary pressures subside, we think there's room to continue to lower interest rates. But if this doesn't happen, then central banks will have to act otherwise. On the other hand, fiscal discipline is absolutely key to ensure fiscal sustainability. As I said, there's more pressures, and so fiscal discipline is quite important. And I would like to highlight in particular for low-income and middle-income countries in different parts of the world, you can see that debt service, so how much countries are paying in terms of interest payments. Interest payments now are higher in many of these countries than they spend on education, they spend on health, they spend on infrastructure. And so once again, going back to fiscal discipline is absolutely essential, not only to avoid crisis down the line, but also to give the fiscal space that you need to invest in education, health, and infrastructure in other areas. So we think this is quite important. In the current juncture, the OECD, as you all know, always highlights the importance of structural reforms. And we think in the current juncture, there's never been a more pressing issue than going back to reforms. In particular, we think that there is a lot of red tape, there's a lot of excessive procedures, there are a lot of barriers to services, there are a lot of barriers to telecom and energy, there are a lot of barriers that could be decreased. And we know, well, our research shows that when you lower these barriers, when you cut red tape, when you cut regulatory costs, this has a significant impact on growth and impact on productivity. So we urge governments to go back to reforms and reduce these barriers so that you improve performance. On the other hand, as the Secretary General highlighted, a recent paper that we have on artificial intelligence, we think that the impact of artificial intelligence is going to be fairly significant. Just to put things into perspective, in our history, in our current history, we had sometimes we have what is called the general purpose technology. So we have steam, electricity, we had a few other big technologies. And more recently, we had the computer, the internet, and what we see in terms of AI is another general-purpose technology. The impact of this general-purpose technology usually is much more productivity, more growth, and job creation. And in fact, our paper shows, by taking into account the exposure of sectors to AI and the adoption of AI, that AI will have a significant impact, about 0.4 to 0.9% growth of labor productivity over the next 10 years, which can be increased if you take into account robotics. Well, what countries need to do in order to speed up the diffusion? The Secretary General highlighted a few, which basically means, more investing in skills, investing in infrastructure, and be able to have very agile economies so that you are able to benefit from the productivity impacts of AI. But we think this is very important, and we could accelerate some of the trends that we've seen, which is, for example, a productivity divergence that we've seen between the United States and other parts of the world, and likely AI, at least in the short run, will exacerbate these issues as well. Finally, we'd like to highlight something that it's quite important to say. The Secretary General was mentioning keeping markets open, keep the multilateral dialogue open. And so we estimated also in our simulations what could happen if everybody reaches a global deal and is able to decrease average effective tariff rates by a not so big amount, 1.5%. But what you can see that the growth effects, both for the advanced economies and also for emerging markets, are quite significant over the period of 3 years, and also lower inflation. So if everybody is able to reduce tariffs and is able to reduce protections, if we are able to get a deal that we are able to bring tariffs down and protections down, this will have a significant impact on growth and lower inflation. So finally, I just would like to sum up. So we are in a period, obviously, of significant uncertainty, and we think that most important policy that countries need to follow right now is try to avoid further trade fragmentation, because this will help growth prospects. In terms of monetary policy, we think that monetary policy should remain prudent at current junction, but fiscal discipline is absolutely essential so that we are able to reduce debt burdens across the world, and finally, go back to reforms so that we are able to bring more growth, more prosperity, and higher living standards for everyone. Thank you.
So with that, we're happy to take some questions.
Thank you very much, Alvaro, Secretary General. Indeed, we're ready for the questions. Those of you watching online, please put those into the chat function on the Zoom. We'll go first. Anyone here in the room who might like to ask a question? Right here.
Ángel Calvo from the Spanish press news agency EFE. Can you explain a bit why the impact of the American economy of these first measures are quite slight? I mean, the reduction you have made is very, very important for Mexico and for Canada, but not for the U.S. Can you explain a bit more? And can you say a bit more, too, about the case of Argentina? Thank you.
Okay. Well, first of all, remember, in terms of to get these estimations, we need to see the degree of openness of countries, right? So the United States is a big country. Trade to GDP ratio is much smaller than it happens in Canada and Mexico. Just to give a perspective, Canada exports 73% of its goods to the United States, Mexico about 74%. But more importantly, Canada and Mexico export between 20 to 25% of their GDP to the United States. The United States, much smaller impact because it's much bigger, is a bigger economy. And so the impact is obviously smaller in the United States because the United States, it's much less open than the other countries. That's the reason. But we know that the impact is significant for the three economies because of a lot of not only the tariffs very often impact intermediary products, okay, or intermediary goods, which means that if you're producing a car or producing another good that might be sold in the United States, but usually goes through Canada or the United States border, or the Canada-United States border, or the Mexican-United States border several times. And so these intermediary inputs will certainly, with these tariffs, will increase costs, and as a consequence, this will have an impact on the price that consumers and firms will pay. Okay, but the reason why the U.S. economy is relatively less affected is because of that, but we downgraded the United States 0.2% this year and 0.5% next year. So it's a significant impact as well. Okay, on Argentina, what the adjustment has been is having significant impact, not only in terms of right now having surpluses, fiscal surplus, but also inflation that used to be around 23-24% per month right now is 2.2%, and it continues to decline. This is quite important because, as we all learn in the past few years, when inflation happens, this has an impact on real incomes. In fact, there was a significant increase in poverty rates to about 50.3% in Argentina, even though the latest numbers right now show there's about 30% or a bit more. But what we're saying is that basically the adjustment on the macro side is going very well. The recovery is significant, and we also like many of the reforms that have been implemented. So we expect the economy will continue to recover. So the third quarter and the fourth quarter, there were very strong growth, especially in the third quarter, and we expect this will continue as long as obviously the adjustment continues and the good macro performance carries on. Okay, thank you.
Other questions here in the room? Looking around if there's not, I'm going to go to some of the questions we have from the Zoom. To start with one from Paolo Levi with the Italian press agency ANSA. What impact will the American trade actions have on the Italian and European economy? And how can Europe resist these new tariffs?
Well, these tariffs so far have not impacted a lot Italy. We have not assumed additional tariffs. We know that there's been discussions that there might be additional tariffs. We have not taken into account because we only take into account in our base scenario policies that have been announced and legislated. And so nothing has happened there. And so that's why we do not estimate the impact for the Italian economy. Or the European economy. But of course, Italy is a country that exports a lot, and so if the world becomes more protectionist, if you export a lot, you're going to be affected. And so very likely this will happen going forward, but let's hope that this is not the case.
Moving to a question from Lee Thomas from Reuters. Do you expect the United States to enter a recession if it keeps escalating this trade war?
Well, this is not our base scenario. Right? Our base scenario is that the United States will grow 2.2% this year and 1.6% next year, far from a recession. And so that's what our baseline scenario. I'm not going to speculate on other possibilities.
A question from Will Horriban with Bloomberg. He asks, Europe is about to ramp up spending on defense. How could this change the outlook for the European economy?
Well, obviously, in the short run, if you spend more, it's not only defense, it's also infrastructure. This is something that we've been saying for Germany for many, many years. You know, Germany has a deficit in terms of infrastructure, especially digital infrastructure. There's a lot of investment to be done. So we think that the spending will certainly help, not only in the short run, but in terms of infrastructure, will probably help in the long run as well, the German economy. But if you spend more on defense, of course, in the short run, if you spend more, you're going to have a positive impact on growth. We have not taken this into this is a positive risk scenario, a positive risk for that upside risk that we put in our forecast, but we don't estimate it in our baseline scenario for the simple reason that we have not we don't know all the numbers and we don't know exactly how this will be implemented. This has not been legislated, but that's the reason. But it's an upside risk scenario that we have for Germany and for the European economy.
A follow-up question from Bloomberg. Are the trade tensions raising the risk of global financial disruption?
Well, uncertainty certainly has risen, and so if we continue to have a world of a lot of uncertainty, very often investors and the stock markets react. So if we continue to have significant uncertainty, it's possible that stock markets will continue to react.
A question from the UK, Tim Wallace at the Daily Telegraph. Can you expand on the fiscal challenges, particularly in countries like the UK? Are tax rises impacting growth in the UK? And is there any alternative to tax rises when governments need to spend more on defense?
Well, for the UK, we downgraded mostly because the latest data was a bit lower. But we still, compared to a few months ago, we still think that the UK will grow a bit more, so 1.4% this year and 1.2% next year. We think this is mostly because consumption was a bit affected. That's why that was one of the reasons. The UK obviously has a situation in which it needs to invest a lot on, as well, infrastructure. It needs to invest more in defense. It needs to be able to decrease part of the regional inequalities. And you only have two options. Either you raise more revenues or you decrease spending. And so in this case, an increase in revenues, we don't think that is going to have a substantial impact on growth. That's not our forecast. So, of course, this is incorporated, but it's not going to have a significant downturn on growth.
Just looking here in the room if there's any of the other journalists who have any questions. If not, I'm going to go back to the Zoom. Those of you watching on the Zoom, please keep putting your questions in there. A question from Wenxin Li from the Chinese news agency Xinhua. How do you think the tariffs will impact world trade, and particularly the impact on supply chains?
Well, tariffs usually depress world trade. This is what we are. Of course, we've seen in the past 2 months that world trade has increased a bit, partly perhaps a reaction of anticipating tariffs. But we expect that world trade will certainly be affected by. If you have a more protectionist world, if restrictions increase, that means that trade becomes more expensive. You'll trade less. And so this usually has a negative impact on trade.
Final question here in the room, if there aren't any others. We've run out of those from the Zoom as well. Thank you very much, Secretary General Alvaro. Thanks to all of you watching. You'll find all the information about the Interim Economic Outlook on the OECD website. Have a very nice day.
Very good.